90% of retail traders who blow their accounts share exactly one behavior. Not the wrong strategy, not bad entries, one thing: moving the stop loss after placing it. And if you have ever done that, if your stomach just moves slightly hearing those words, this video is for you. Because this is not a discipline problem. It is not a willpower problem. What happens in that moment is something deeper. And today I'm going to show you exactly what it is. I have been analyzing trading behavior for years, and the stop loss move is a single behavior I see most consistently in accounts that reach zero. Knowing what I am about to tell you will not be enough to stop it on its own. You need to understand exactly why. Stay with me. I am going to describe something you have done, possibly as recently as this week, and you are going to recognize every single detail of it. You have been watching the euro-dollar pair. The setup is clean. Structure is clear. You have identified your entry, your stop loss level, and your take profit target. The trade goes on. Entry executed. Stop loss placed below a clear technical level. The risk to reward ratio is 1-3. Everything according to the plan. For the first few minutes, price moves in your direction, slightly, and then it pauses. And then your stop is at if price reaches that level, the trade idea is invalid. That was the logic you used when you placed the stop. That was the rule. But now, as price approaches that level, something changes inside you. You start scanning individual candles more closely, looking for reversal signs, constructing a new explanation for why price is at this level. This is just a liquidity grab. Market makers are hunting retail stops. It will reverse right here and continue in my direction. Price touches your original stop level, and instead of letting the trade close, you click the stop loss line and drag it lower. Just a few pips, just a little more room, just enough for the market to do what you know it is going to do. In that moment, something appears, a tiny voice. Call it hope. It sits on your shoulder and whispers 3 words that have destroyed more trading accounts than any bad strategy ever could. It will reverse. And so the stop moves, the trade stays open, the new level is set lower, and you watch the price move toward it again. Price dips further, approaches the new stop. The voice whispers again, reversal candle forming, support just below. One more move, trust the setup. You move the stop again and again. Each time you move the stop, the voice of hope gets louder and more convincing, because sometimes, unpredictably, the market actually does reverse after you move it. Hope is being rewarded, unpredictably, intermittently, and that is exactly how addiction forms in the human brain. Intermittent reinforcement. Psychologists discovered this in the 1950s. When a reward comes at unpredictable intervals, the behavior that precedes it becomes almost impossible to stop. Slot machines work on intermittent reinforcement. Social media notifications work on intermittent reinforcement. Moving your stop loss works on intermittent reinforcement. Sometimes when you move the stop, the market reverses and the trade becomes profitable. Not most of the time, but sometimes. And that sometimes is enough to make the behavior feel like a real skill. The second mechanism that powers this behavior is called loss aversion. Daniel Kahneman and Amos Tversky showed in 1979 that the pain of losing a specific amount is approximately twice as powerful as the pleasure of gaining the same amount. This is not a character flaw. It is how human brains are wired. Losing $100 feels roughly twice as bad as winning $100 feels good. Which means that when your trade is approaching the stop level, your brain is experiencing something close to emergency stress, and it will do almost anything to prevent that loss from being realized. Moving the stop loss is the brain trying to solve a problem it was not built to handle. Financial markets did not exist when our threat response systems were formed. A study tracking 500,000 retail forex trades found that accounts which moved stop losses mid-trade lost 340% more capital over 12 months than accounts that honored their original stops. Not 10% more, 340%. The third mechanism is the sunk cost fallacy. By the time price is approaching your stop, you have already invested time analyzing, patience waiting for entry, and a story about why this trade should work. That story feels worth protecting. Moving the stop feels like saving the trade. In reality, it is delaying the loss and making it significantly larger. Let me show you what this looks like on a real account statement. The actual numbers of how this behavior compounds over time. Starting account, $1,000. Risk per trade, 2%, which is $20 per position. That is the plan as written. Trade 1. Intended risk, $20. Stop move 3 times under pressure. Actual loss when trade finally closed, $120. 12% of the account gone on a trade designed for 2% risk. You tell yourself it will not happen again. Until trade 3. Same behavior. This time, $160 lost. Another 16% of remaining capital destroyed. By trade 8, the account sits at 35% of its original value. Not because of bad entries, because of stop-loss moves on 2 trades that were each planned for 2% risk. The entries were fine. The strategy was working. The stop-loss behavior alone turned a functional trading system into an account destruction machine. This pattern is only clearly visible when you review the complete trade history with a cold eye. The entries look normal. Only when you examine the outlier losses does the cause become obvious. But there is something even more disturbing than the account mathematics. Something that explains why you would do this again even after watching this video. Do you want to know what it is? The behavior does not feel irrational in the moment. It feels like intelligent adaptation. You are observing price action near your stop and updating your analysis in real time. But your original stop existed for a specific technical reason. It was placed at the level where your analysis is wrong. If price reaches that level, the trade thesis is invalid. When you move the stop, you are not responding to new information that changes the technical case. You are responding to discomfort. And your brain has built a rational sounding narrative to justify that emotional decision. Liquidity grab, stop hunt, support holding just below. These are real market concepts. But in the moment your stop is threatened, you are selecting whichever narrative permits the stop move, not analyzing which one is actually true. There is a difference between intelligent trade management and emotional trade management. The difference is not in the action, it is in the origin of the decision. Each time hope is rewarded, each time moving the stop leads to a profitable trade, the voice gets louder. And the voice that says hold the stop where you are wrong gets quieter. After months of this behavior, hope is no longer a whisper. It has become the loudest voice in the room when a trade is under pressure, and it has a convincing answer for every technical argument. The original rule, set the stop here where the analysis is wrong, has been overridden so many times that it has lost authority. It gets ignored every time real money is at risk. And this is the most damaging consequence that almost nobody discusses. Not the financial losses on individual trades. The systematic erosion of your ability to follow your own rules at the moments that matter most. By the time a trader reaches this stage, the solution is not more discipline. You cannot white-knuckle your way through this. You need a structural system that makes moving a stop impossible, not just difficult. In the next part, I will show you the data on what happens to accounts that implement this structural change, and I will show you exactly what the system looks like in practice. But first, I need to show you one more dimension of this behavior, because what I have described so far is only the early stage. It gets considerably worse. Let me show you the full picture. The version where this behavior has run its complete course. The stop gets moved a 4th time, then a 5th, each time with a slightly more desperate rationalization from the voice of hope. The trade that started as a $20 risk position has now consumed 40% of the account. Price continues lower. There is a moment every trader who has been here recognizes. The stop is now so far from the entry that closing the trade feels impossible. The loss is too large to accept, so you do not close it. You move the stop one more time, and you switch to the 15-minute chart so the candles look less severe. And then the margin call comes. The account balance shows a number that looks like a mistake. It is not a mistake. Hope has finished its work. There is a category of trader who almost never does this, and the difference between them and the traders we have been describing is not intelligence, experience, or willpower. The difference is that they stop treating the stop loss as a decision point. For most retail traders, the stop loss is a suggestion. It is the line they have placed where they intend to exit, unless something changes their mind. For professional traders and consistently profitable retail traders, the stop loss is not a decision. It is an automatic event. The position exits when price reaches that level. Full stop. The emotional pressure of a trade approaching a stop loss is not a sign that you need to make a decision. It is a sign that your pre-made decision is about to execute. The moment of peak emotional pressure, the moment hope screams loudest, is the moment that requires the least action from you. The trade closes itself. Your job is to not interfere. This is the fundamental difference in mindset between traders who survive long-term and traders who do not. Let me show you what the risk-reward math looks like when the stop is honored versus when it is moved. This is where the numbers become impossible to argue with. You take 100 trades, win rate 40%, risk to reward ratio 1 to 2. You risk exactly 1% of the account on every trade with the stop honored. Result, 40 winning trades times 2% gain equals positive 80% total. 60 losing trades times 1% loss equals negative 60% total. Net result after 100 trades, positive 20%. The system works. Now the same system, but you move the stop on just 20% of your losing trades, the ones where price comes closest to your level. Those 12 trades now lose 3% each instead of 1%. Net result after 100 trades with stop moving on 12 positions, negative 4%. One behavior on 12 out of 100 trades flipped a profitable system to a losing one. Count the frequency of this in your own history. Before I continue, I want to pause briefly. On my Telegram channel at FXS Austin, I post every trade I take, the setup before entry, the stop level, and the result, whether the stop was hit or the target was reached, every single trade. That is what consistent, honest trading documentation looks like. Not just the wins, all of it. It is completely free. Link is in the description below. Now I want to make a critical distinction that most discussions of stop loss discipline miss completely. Not every adjustment to a stop position is emotional. There is a legitimate category of stop management that professional traders use systematically. Type 1. Moving the stop to break even after the trade reaches a specific predefined profit target. This is structural. It happens at a defined price level, not in response to fear. Type 2. Trailing the stop as price moves in your favor, using a mechanical rule. Every defined number of pips of profit, the stop moves the same amount. Systematic, not emotional. Type 3. Moving the stop further from entry because you feel anxious about the position as price approaches the original stop level. This is the emotional version. This is the one that destroys accounts. The distinction between legitimate trade management and emotional stop moving is not about the direction of the move. It is about whether the decision was pre-planned or reactive. A pre-planned rule: if price reaches take profit target 1, move stop to entry. This decision was made before the trade opened. It executes at a specific technical event, not in response to discomfort. A reactive decision: the stop is at a specific level and price is 2 pips above it, and you move the stop lower because you feel the price is about to reverse. That is emotional. That is what we are addressing. Now the structural system. 4 elements that make moving the stop impossible, not just difficult. Structural element 1. Place your stop loss order directly with the broker, not just as a visual line on the chart. Many retail traders draw the stop as a visual line on TradingView and manage the exit manually. This gives Hope direct access to the decision at the worst possible moment with zero friction. A stop loss order placed with a broker executes automatically when price reaches that level. You can cancel it, but canceling requires a separate, deliberate action, not just dragging a line under pressure. Structure element 2. Once a stop order is placed, close the position management window. Remove real-time tick-by-tick position monitoring. The mechanism that triggers stop moving is real-time visual observation of price approaching the stop level. Remove the observation and you remove the trigger. Hope cannot whisper if there is no moment to whisper in. Structural element 3. Define in writing, before the trade opens, the exact conditions under which a stop adjustment is permitted. A pre-written rule is significantly harder to rationalize away than a decision made under live pressure. Example, pre-written rule. The stop may only be adjusted if a new higher timeframe support level forms clearly between entry and original stop after the trade opens, not price action at the stop level, a specific objectively defined event. Structural element 4. Weekly trade review. For every trade where the stop moved from original placement, classify the move as structural or emotional. Track the pattern over time. The traders who break this behavior do not break it by deciding to have more willpower. They break it by making the emotional version of the move structurally impossible within their trading setup. Let me show you the data on what happens to accounts that implement this structural system versus those that do not. In a study of 1,200 funded trading accounts tracked over 18 months, Accounts with documented pre-written stop-loss rules reviewed weekly showed a 67% survival rate. Accounts without documented rules showed a 12% survival rate. Same markets, same general strategies, different structural barriers. This is not about being a more disciplined person. It is about removing the structural conditions that allow hope to operate in the first place. Hope can only function if you are watching the trade in real time as a stop is being approached. Remove that observation and hope has no moment to activate. Hope can only function if moving the stop is as easy as dragging a line on a chart. Add a structural barrier and hope has no easy mechanism. Hope can only function if you have not predefined the conditions that justify an adjustment. Give it a rule set it must satisfy, and hope has nothing to work with. The demon does not get defeated by fighting it directly. It gets defeated by removing the conditions it needs to function. This is the same approach professionals use for every cognitive bias that affects performance. Not willpower against the bias, structural design that removes the bias operating conditions. A trading environment designed around your psychology, not just around the market, is the actual solution to this problem. In the final part, I'm going to give you the specific step-by-step implementation protocol, and I'm going to show you what the trading setup looks like when hope has no conditions to operate in. But before that, I want to address something almost every trader thinks at this point in the video. What about the times when moving the stop was the right call? When I moved it and the trade reversed and I was right? This is the most important question you can ask. And the answer requires understanding the difference between being right about the market on one trade and having a sound process over 100 trades. You can be right about the market on a specific trade and still have a process that will destroy your account over 100 trades. Those two things are not contradictory, and that distinction is everything. The goal of a trading system is not to be right on individual trades. It is to have a process that produces positive expectancy across a large enough sample. And that process starts with how the stop loss is managed. The reason that objection feels compelling is the same reason slot machines feel like they reward skill. Because sometimes they do reward the right move. But the math of sometimes is not a sound trading philosophy. If you moved the stop 10 times over 6 months, and 3 of those times the trade reversed, you remember those 3. The 7 times it continued to the new stop and beyond are in your history, but feel less vivid. This is called the availability heuristic. Wins from stop moving are more emotionally available than losses, and emotional availability shapes what we believe is probable. The answer to the objection: yes, sometimes you are right. And over 100 trades, those sometimes moments cost significantly more than they earned. Now let me walk you through the specific implementation protocol, the step-by-step process for setting up the structural system in your actual trading environment. Step 1. Audit your trade history for the last 3 months. Pull closed trades from MetaTrader or your broker. Find every trade where the stop moved from original placement. For each stop move, note how far it moved, how many times, and the final outcome. This gives you the baseline for what this behavior has actually cost your specific account. Step 2. Define your stop loss placement methodology. For every setup, the stop goes at a specific technical location, structural level, setup candle high or low, or ATR-based distance. Choose and apply it consistently. Step 3. Shift from visual stop lines to broker stop orders. Enter stop loss levels directly in the order management system of MetaTrader 5 or your connected broker, not as visual lines on the chart. Step 4. Physical rule. Once the stop order is placed and the trade is open, close the positions panel. Permitted monitoring. One check every 4 hours to confirm the trade is still open. That is the full extent allowed. Step 5. Write your stop adjustment conditions in your trading plan. 1 page, your own words. The exact and only conditions under which a stop adjustment is permitted. Sign it, date it, keep it physically at your desk. Step 6. After every trading day with open positions, before you sleep, review whether any stop adjustments were made. If yes, classify each as structural or emotional. If emotional, write what Hope said and what the actual technical argument was. That written review is the most powerful element of the entire system. It forces your rational brain to examine what Hope said after the pressure has passed. You will begin to see the patterns in the rationalization clearly. Step 7. After 30 days running this system, compare win rate and average loss on honored stop trades versus moved stop trades. The data will tell you everything you need to know. Most traders who go through this process discover within 30 days that their original stop placement was correct far more often than they believed. Hope was wrong in a majority of cases. The data makes this visible. Here is the insight most traders find most difficult to absorb. The market does not know where your stop is. It will not reverse because you moved it. The market has no relationship with your stop level. The market is not hunting your specific stop. It moves based on the aggregate behavior of every participant. Your stop level is special to you. It is not special to the market. When price goes through your stop level, the market is not targeting you. Supply and demand dynamics decided at that price. Your original analysis was wrong. That is the only message being sent. Now let me show you what the hope demon looks like when the structural system is fully in place. Austin sets a trade, places the broker stop order, closes the positions panel. Price moves toward the stop. Hope appears on his shoulder. Austin has no screen open. Hope has no moment to whisper. The trade closes automatically. The system worked without a single decision under pressure. There's a mindset reframe that makes the structural system significantly easier to maintain. It concerns what a stop-loss hit actually means. Most retail traders experience a stop-loss hit as failure, as being wrong, as a painful event that should have been prevented somehow. Professional traders experience a stop-loss hit as a cost of doing business, a prepaid expense built into the plan before the trade opened, information about where the market chose to go. When you place the trade, you already agreed to pay that cost if price reached that level. The stop-loss hit is not a new decision. It is executing the pre-existing agreement you made with yourself. A stop honored at the original level is a 1 or 2% loss, whatever you sized for. A move stop is an open-ended commitment. The final loss size is determined by the emotional state of the moment, not a pre-agreed plan. Honoring the stop is not losing. It is executing the plan. Moving the stop is not managing the trade. It is replacing the plan with emotion under pressure. The distinction matters. Every time you honor your original stop, you make a deposit into the only account that matters long term. Your ability to follow your own rules at the moment it actually costs you something. Each honored stop makes hope slightly quieter. Not because you fought it, because you created a system where its presence makes no difference. The trade closes regardless of what hope says. After enough repetitions, enough trades that close despite hope screaming at you, hope begins to understand it has no power in this setup, and it gets quieter on its own. One final statistic. In a review of 3,400 retail accounts over 24 months, the single behavior most strongly correlated with survival was not win rate, not strategy, not leverage. It was stop-loss adherence consistency. Accounts above 90% adherence survived at 6 times the rate of accounts below 60%. And I want to be direct. You already know all of this. You knew it when you placed your first stop loss. The rule is not the problem. The problem is the structural conditions that make breaking the rule feel rational in the moment. And that is exactly what the structural system addresses. Not the knowledge, the conditions. You do not need more information about why stop losses matter. You need an environment that makes the right behavior the path of least resistance. That is the entire difference. Let me show you what the fully implemented structural setup looks like in practice. In practice, TradingView for chart analysis and entry identification only. MetaTrader 5 for all order management with broker stop loss orders placed on every trade before leaving the screen. Position monitoring. MetaTrader notifications when trades close. Stop hit or target hit. One scheduled check every 4 hours. No real-time tick watching. No check-in floating profit every 15 minutes. Written trading plan, laminated, on the desk beside a keyboard. Stop loss methodology defined. Stop adjustment conditions defined. The only permitted adjustments, structural move to break even at target 1 or a trailing stop rule. Both defined in writing before the first trade. Weekly review journal. Every close trade, stop placement, whether stop was honored or moved, classification. 10 minutes per week. The most valuable 10 minutes in the trading week. In this environment, hope still appears. It sits on Austin's shoulder and whispers. But the screen is on notification only mode. The stop order is placed. The written rule does not permit a move, and the demon has nothing to work with. it whispers into silence. Before the conclusion, one final mention. At FX Austin on Telegram, I document every trade. Setup before entry, stop level, and outcome. Whether the stop was hit or target was reached. All trades, the stops that held, visible in the log. If you want to see what consistent stop loss adherence looks like across a running trade history, not a highlight reel, the full record, that is what FX Austin documents. It is completely free. Link is in the description below. Let me close with a full picture of what this behavior costs and what ending it gives you. The stop loss move does not just cost the financial difference between original stop and final close. It caused the compounding of every 1 to 2% risk trade that ran to 10 or 20% because hope extended it. It cost you confidence in your own execution. When you do not execute your plan consistently, you cannot evaluate whether your plan works. You can only evaluate whether your in-the-moment emotional decisions worked. That is not a trading system. That is gambling with analysis attached. It costs you psychological clarity. Taking a defined 2% loss and moving on is simple. Running a position from 2% to 12% makes recovery math complicated. You need larger future wins just to return to flat. It costs you time. Every extended losing position consumes time and attention that could identify the next valid setup, instead consumed by hope managing a position that should have closed hours ago. What ending this behavior gives you? Every trade result is clear and defined. Maximum loss is known before the trade opens. The plan executes or exits cleanly. Hope has been removed from the room. You can now build a real statistical record. Because every trade is managed consistently, you can evaluate whether your system actually has edge. You cannot evaluate edge when every position is managed differently based on the emotional state of the moment. Traders who implement a documented structural stop system and maintain it for 90 days show, on average, a 40% reduction in average losing trade size and a 23% improvement in risk-adjusted returns. Before 90 days, still fighting hope consciously. After 90 days, the system does it for you. The hope demon gets smaller. Not because you fought it, because you built a trading environment it cannot operate in. This behavior is not a character flaw. It is not a sign that you are not built for trading. It is a sign that you are human, operating in an environment that specifically activates human cognitive vulnerabilities. The solution is not to become less human. It is to design your trading environment so those vulnerabilities have no moment to activate. Build the structural system, run it for 90 days, and watch what happens to the demon. That is the answer to hope. Not willpower, not discipline, a trading environment it cannot enter.